So I'll just get started. Hello, everyone. My name is Christian Harrison. I work at a First World Mortgage. First of all, thanks for coming out on a Saturday to hang out with us. And sorry about the weather. I was just talking with Romano. As soon as we decided to do a Zoom meeting instead of having it at the office, the snow stopped. So I guess Mother Nature always tries to mess with us in Connecticut. But yeah, Christian Harrison, First World Mortgage is my company. We've been around for over 30 years, I believe. I've been doing this for 18 years. I also have my brother here, Benjamin Harrison at First World Mortgage. He's the better looking, smarter version of me, who has a better beard. Say hi, Ben.
Everything you said is true, Christian, about me. Yeah, it's nice to meet you guys. Sorry it's not in person, but yeah, look forward to meeting you at some point. So it's good to be here.
Definitely. So thanks again, and sorry for the weather, but I have the greatest job in the world. To sum it up, I get to give you guys money, and the best part is I don't have to pay it back. You guys do, so it's like the perfect job. But no, love what I do. Been doing it for a while. First World, we're happen to be the #1 first-time home buyer lender in the state of Connecticut. You've probably heard of and if you haven't, I'm going to go over it. But the CHFA, mortgage with down payment assistance, we do the most of those out of anybody, and it's not even close. So we love trying to get you guys in positions to buy a house without having to put money down. So it's a great product. I just found this out. We're actually the #1 rehab renovation loan lender in the state of Connecticut as well. So, we'll go over all those products as we go. And we're a direct lender, which is my favorite part of this thing because we lend our own money. And so I have access to, the underwriting and, so those underwriters are people that are going to ultimately say, yes, we're going to give you a mortgage, or no, we're not. So it's nice to be able to walk upstairs and, bring a bottle of wine or maybe some candies and say, hey, let's figure out this loan. Let's get it closed. And, it really has worked well over the years. So for a lot of you, this is the biggest investment up to this point you guys are ever going to make. So it's really important that you guys choose the right professionals that can guide you through the process. A realtor like Fabian, Ryan, or Romano. Very important to choose a realtor that's going to help guide you through the negotiation process, finding a house that's perfect for you, inspections, someone you can trust. Then a mortgage lender like myself, who's going to make sure you're comfortable with all the financial part of it and make sure you're pre-approved and ready to buy a house. And an attorney, of course, you want to make sure that you have someone that's able to review contracts for you, make sure you're protected, and make sure everything's up to par legally. So you're doing this the right way. So these are all the people that play really important parts. And then you're going to get into homeowners insurance, home inspectors, stuff like that. I'm the best first step, me and Ben. You're going to come to me before you even go out and start looking at houses with Romano, Fabian, or Ryan. You're going to want to know, A, what you're qualified for, but even more importantly, what you want to qualify for. So what I mean by that is, I can say, hey, good news, you're pre-approved for a $1 million mortgage. Does that mean you want to make a payment on $1 million? Probably not. You want to make sure you could eat food, make the mortgage payment, and live a life that you're used to living right now. And that's a whole goal with us. We want to make sure you're comfortable and, not shivering in the corner with the heat off, eating ramen noodles, trying to make the mortgage payment. That's not what we want. So, when you go out and you start looking at properties, you're going to need a pre-approval letter. You can't make an offer and make a move without someone like me or Ben saying that you're good to go and that you're qualified to do this thing. So, when we talk to you, if you're not there yet, we're going to give you a roadmap to tell you, how you can get there and how you can get qualified. So we're going to go above and beyond and make sure that, if you can't do it now, we're here to guide you throughout the rest of however long it takes to get there. Hopefully it's short. If it's not, then we're still going to be there. So listen, why is it a good idea to buy a house now? I mean, if you're watching the news right now, you're probably thinking this is the worst thing in the world right now. No one can qualify for a mortgage, but you look at it now, rates are going up a little bit. Prices are high, gas is high, market's crashing, lumber's overpriced. It's like everything seems to be going haywire, right? But really, if you look at it historically, rates are still at an all-time low. I mean, they might have gone up a little bit, but the bottom line is, I always think about Mom, Ben, when she was in the 80s. She always talks about how she refinanced from, I think it was like a 19.5% to a 13%. And she's out buying drinks for everybody, celebrating, so it's a different time, right? I mean, right now we're kind of spoiled with how low interest rates are. So really still is a great time to buy. And, when you talk about, I bet most of you guys are renting right now, I'm assuming. Maybe you're not, but this is a first time homebuyer seminar, so I'm assuming maybe a lot of you are renting, maybe some of you are living with family. But when you compare rent to buying a house, a lot of times this might surprise you, but you can get your mortgage payment could be, not more than what your rent payment is, maybe even less. And even if it is more, there's certain things that a lot of people don't think about when it comes to owning a house, as opposed to renting. In other words, when you're renting and you're paying rent, that money's doing really nothing for you. When you pay a mortgage, you have a lot of tax deductions. The thing that's stinky about a mortgage is that the first 5 years of your mortgage, you're paying mostly interest. What that means is, you're making this mortgage payment, you're saying like, geez, I'm paying like, $1,500 a month. Why is not my loan's not going down that much at all? Well, because most of it's front loaded with interest. And what happens is with every payment you make going forward on a mortgage, every single payment, you're paying more and more and more towards principal. But the good thing about that interest is that it's tax deductible. All the taxes you pay in your mortgage payment are tax deductible. So like a lot of times you're getting back at the end of the year, $3,000 to maybe even $6,000-$7,000 more on your taxes every single year. So, I always take that and I divide it by how many months are in the year. And, you could be actually paying less than what you're paying for rent right now with all those tax deductions. Another benefit to owning a house is, you're also gaining something called equity. So say you buy a house for 200,000 and let's say in 5-6 years you pay it down to 170, 160, something like that, and you go to sell it and it's worth 260. Well, that's $90,000 to $100,000 that you have in your pocket just by owning a house. I mean, that really is it's a way you can get rich in America. It's a way you can retire. And you're not getting that when you're renting. Basically, when you're renting, you're giving that money to the landlord. You're paying his or her tax write-offs. You're gaining his or her equity for them. So why not, be in a position where you can do that yourself? Heck, buy a multifamily, rent out to a tenant, and have them, pay you rent where you're getting tax write-offs from rental income. I mean, it really is something where you can get your life started in a positive direction. And then plus you have no landlord in your face telling you what you can and cannot do, raising your rent. You're in a much more control of your living situation, which is a nice feeling. So are you ready to buy? Basically, that's what Ben and I are going to be here to tell you. And again, we're going to try to help you, figure out what you need to do to get ready to buy if you're not ready now. But the most important thing that you're probably a lot of you don't know, because a lot of places charge to talk to them about getting pre-approved. It costs nothing to talk to me and Ben, nothing. I mean, we're going to just, there's no application fee. So there's just to run credit and talk and get pre-approved. You don't pay a dime in terms of mortgage cost until you close on a mortgage. So you don't have to worry about that. So the first step in determining you're ready to buy, might as well talk about the elephant in the room right now. Credit. Yes, I know it's the scariest thing to take a look at. Sometimes people equate talking to me and running credit to going to the dentist, which is, I mean, come on, the dentist. I hate the dentist. I don't want to be compared to going to the dentist. It's the worst feeling ever when I walk in that door and know that my gums are going to hurt no matter what has to be done. But anyways, bottom line is there's two really important things with credit. The obvious one, make your payments on time. That's one thing that could make or break your credit. I got to make sure that she's not listening, but credit is like my wife. It's like you do one thing wrong and she never forgets. And it takes a long time to get back in her good graces with a lot of good behavior. That's credit. It really is. It's like you do one late payment. It's all of a sudden like you're working to get back into where you need to be. But there's other things too. And I would say the second most important thing is, when you're talking about credit cards, you want to keep your credit card balance 30% or lower than the balance of what your credit limit is. So in other words, you have a credit card, let's say the balance is, the credit limit is $1,000. You really don't want that balance going over $300 at any point. You don't know when it's going to report. So it's good to try to manage it and keep your balance. Really, what happens if it goes over 50%, that's when it could really tank your score. From the other end of it, if you're keeping it below 30%, your score is going to skyrocket. It makes a huge difference. And a lot of times when I'm working with people, I have a program called Credit Rescore, where I can actually take a look at your credit. And sometimes it will tell me, hey, you do this, you pay down your Capital One card, you do this, your score can go up 35 points. And I can get it up in 5 days. So it's really like, instead of waiting, 60 days for it to report, we can I'll do it a lot more quickly than waiting for the credit to naturally report. So it's it's a very important thing. I mean, even me, like when I would say 15 years ago, I bought a TV at Best Buy. Because I'm talking about store cards now. So this is something to be aware of that I didn't know about until I messed up. But I bought this TV, big TV, 60-inch. I mean, I'm old, so at the time it was like one of those projection box looking TVs. And I got it at Best Buy for $3,000. I got a zero interest card. So what the heck? I can impress my friends, have an awesome TV, watch football games, and I don't have to pay any interest on this money. Well, I checked my credit soon thereafter. My credit went down 80 points. I'm like, what the heck happened? I didn't make a payment yet. Well, a lot of times with these store cards is, and in this instance, the credit limit was $3,000 and the balance was $3,000. So I was 100% of what my credit limit is. And that's a big time no-no when it comes to your credit. So those are the things I'll look at. And like I said, sometimes there's things we can do immediately to get it going. Sometimes, it might take a little more elbow grease. You might not have any credit. And then I can kind of guide you on quick ways, how to get secured credit cards, pay gas and groceries with that money, pay it off every month, keep it low, and pay it on time. And you're going to get a score, and you're going to get a good one if we do that. Sometimes it takes a little while to do that. You could also get on someone's card as an authorized user. Sometimes that's a lot more quick than reporting the credit, but you want to make sure that person that you're getting on as an authorized user with has, those two, they paid their credit card on time for 2 years, or, whatever the case may be. Ever since they've had it, they paid it on time. So it's not reporting a late payment to you once you become an authorized user on that account, and that they're keeping the balance, again, 30% or lower than what the limit is, at least 50%. That's key. You don't want to go over that 50%. So credit, that's the first thing we do. We're also going to look at your income, your job history. I mean, typically we go back, we look 2 years. We're going to be asking for documentation like W-2s, tax returns. If you're self-employed, what we're going to want to do is we're going to have to look at your business. We want to make sure that the money that you showed after all your expenses, we're going to take a 2-year average of that income and try to qualify you based on that. So there's a lot different ballgame when it comes to self-employment. Sometimes when you're employed or you're W-2, we can sometimes take what you're making right now. You just got a raise. If you're working 40 hours a week, we can take that income. I mean, we're going to do everything we can to take, obviously, the most aggressive income to qualify you, but at the same time, make sure that you're comfortable with whatever we're qualifying you for. So, we're also going to look at, like I said, job history. We're going to look at assets. We got to look at your bank statements for at least a month or two. The reason why we do that is we want to make sure if you're coming up with a down payment, we want to make sure that you have the money. And if you don't, you and I are going to talk about ways you're going to get that money. We want to stay away from large deposits with cash and stuff like that. You can get a gift from a family member too. And again, a lot of times there's programs that can offer down payment assistance towards down payment and closing costs. There are closing costs on a mortgage. So, sometimes, like I said, down payment assistance will cover that, but sometimes it won't. You'll be in a different product, or sometimes that you don't get down payment assistance for closing costs. But there is still a way you can get your closing costs covered into the price of your offer. In other words, let's say you find a place for $200,000. Romano negotiates it for you. You celebrate, you get it for $200,000. Say the closing costs are $8,000. You could always bump up that price to $208,000, saying that the seller is going to, pay $8,000 towards the closing costs, the taxes, the insurance, and that's just a backwards way to roll in the closing cost to your mortgage. And so the seller's still getting their $200,000, but you're making sure that you're coming up with less money out of pocket. So the most important part about all of this is the most important thing I can tell you. I am not the underwriter. So in other words, you can tell me everything. I encourage you to tell me everything, because I can't do my job to get you into the best mortgage, get you qualified, do what I have to do if you're not telling me everything. Because just because you tell me something is maybe, oh, you know what, denied. No, I'm not going to do that. I'm not the underwriter. I'm going to say, well, look, this is what you have to do to get you to ISC. You have a cash deposit in your account. That's fine. Well, by the time we get a house, we can't see any cash deposits. If we can't explain that deposit on your bank account, we're in trouble, and we can't use that money as down payment. So, let's wait 30 days, get me a bank statement. I won't see a deposit in there, and we're going to be okay. Stuff like that. I mean, we don't want things to come up last minute, because that just ends up, not boding well for you guys. Tell me you're paying child support. You didn't tell me you have a bankruptcy. I mean, we're going to find all that stuff out, but you don't tell me you lose your job. I mean, we're going to find out everything. So might as well tell me everything. We don't want to find it out by the time it already did get to the underwriter, you want to find it out with me so I can tell you exactly what we need to do to make sure you're okay and make sure we can get you a mortgage. So very important. And the good news is with these kind of things, when I'm pre-approving you, not only am I getting everything up front, so we know there's absolutely no surprises. You're never going to run into the situation. I'm sure Fabian, Romano, Ryan, you've run into this before, where you get to all the way in the process. Underwrite has only 2 weeks until closing. You find out like, oh my God, there's an alimony payment. Well, how would you not know? Why don't we know that like 4 months ago? There's never going to be any bad surprises. There's certain things we can't control. You lose your job. The appraisal comes in low or something like that. Well, yeah, then that's stuff we have to deal with. But there are never going to be any surprises when it comes to your financial situation. I want to know everything up front. And the good news is if we have something that's a little complicated, maybe let's see, we took some time off because of COVID. There's been some gap in job history. You just had this most recent job for 3 months, but you worked in a different field before that, but it's kind of on and off. I can talk to the underwriter and say, look, is this something we can improve? So we're a little close here on the numbers. And if they say yes, we're going right to that underwriter for approval, and we have a stamp of approval before we even go out and find a house. So that's an awesome asset to have and an awesome weapon in our arsenal when it comes to making sure that you feel comfortable when you're pre-approved, and that your realtor feels comfortable showing you houses and knowing that there's not going to be any problems that come up at the nth hour. A lot of people out there are just taking your basic information, they're application takers, and then they get the information later. Well, no, we're not going to do that, because we want to make sure that there's no problems, no surprises. And that goes to the other way too. The underwriter might say, we're not ready yet with this one, but if they work their job for 6 months, we'll get them a house. Okay, awesome. That's what we wanted to hear. So lots of different programs that we offer out there. The biggest one for first-time homebuyers is that CHFA with down payment assistance. It covers your down payment. It covers your closing costs. So often you're coming up with little or no money down. If you're coming up, you're coming up with a deposit, to make your offer legit and serious when you're making an offer. But a lot of times I can make sure that you get most, if not all, that money back at closing with this product. So it's an awesome thing that we offer. There's income limits, there's qualification. They're a little more strict when it comes to qualifying you and how much you can qualify for. But I always offer different options if that's not enough, and that's it's not enough to get you the house you're looking for. You can do an FHA mortgage, which only requires 3.5% down. You can they're the most aggressive, and you can go the highest with that kind of product. They're very aggressive when it comes to how high you can go, debt to income ratios. And so that product often bodes well as well. And you can get low rates and low down payment, 3.5% down, stuff like that. USDA, if you're buying a house in a rural area, like let's say Talent or Coventry, something that's in the middle of the woods, you can get 100% financing. And so I can look that up. I can look it up by property, by town, make sure that you're qualified for that kind of product. Awesome product. You pay very little PMI. PMI, if you guys have heard of it, is something you have to pay if you have less than 20% to put down. It's a premium you pay monthly. USDA has the cheapest premium that you could ever get when doing 100% financing. So often makes your monthly payments a lot lower. VA, if you're a veteran of the military, you have a certificate of eligibility. We do these products all the time, 100% financing with no PMI. I mean, that's unheard of. So we have that product. We have a conventional loan. You have good credit. That's a really good product. You put as little as 3% down with that. Often get really reduced premiums for PMI, good interest rates, that kind of thing. And then the PMI on that product will go away whenever you get to the point where you do have 20% equity in the house. So, you buy the place for $200,000 and you pay it down to $160 and it's worth $250. Well, that's 20% equity. That PMI would go away with a conventional loan. And then there's rehab mortgages where you can actually get, things that might need to be done with the house. It might not be up to par. Maybe it needs a new roof, or maybe you hate the kitchen. You want a new kitchen. You want the wallpaper, that lime green wallpaper on your bathroom. You just want to make it so you can actually not puke when you're in the bathroom washing your face. You can do that. It could be for cosmetic stuff. So you can get an estimate from a licensed contractor. Say you find a place for $200,000. I keep using $200,000. It seems to be easy for a dumb guy like me. The rehab is $50,000. You can, you have to put 3.5% down of the combination of the rehab and the purchase price. So 3.5% down of $250,000 in that example. So it's a way you can actually put the rehab into the mortgage and not have to pay it out of pocket at all. Great way to get a house that's worth a heck of a lot more once you're done doing the rehab. I mean, I do these things all the time where afterwards I'll do a no closing cost refinance, get them into a conventional loan, eliminate the PMI, get them to a cheaper rate because their house is usually worth a heck of a lot more than what they paid for it because of all the rehab they did. So it's an awesome product, and that's why we do those kind of things all the time. And then we have some creative products too. We call them non-QM, but like maybe you don't qualify with their, maybe you're self-employed and you're not showing enough money on your tax returns. We can take the deposits that go into your bank statement and maybe still qualify you for a mortgage. Sometimes there's no income verification, asset programs, like a lot of creative stuff is starting to come back that I used to see back in 2007, 2005. These are higher rate, higher cost products. Often you have to put, a little more money down, like 10%. But they're an option if we need to get you into a house. So now you're pre-approved. Now the fun part starts. You get to go out with Romano, you get to go out with Ryan, you get to go out with Fabian, you get to start looking at houses. And the good news is I have all your information. So I'm going to be guiding you through this process. You find a place you like, call me, based on what the taxes are, and what you're putting down and what the price you are negotiating, I could let you know exactly what your monthly payment's going to be. So you can make sure you're eating food and you can make the mortgage payment at the same time. And this house makes sense for you. So I'm going to be here guiding you throughout the entire pre-approval process. Of course, Romano and Ryan and Fabian will be doing the same thing. And guess what? I don't know if I brought, they're probably going to bring this up as well. They cost nothing as well. So it costs nothing to talk to me, costs nothing to get a realtor, to start looking at houses. And on the buy side, the seller pays all the real estate commission. So you don't have to even worry about it. So, that's basically my spiel. I mean, listen, I guess this is the last important thing that I don't want to forget. I have a do nots list. If we were doing this live, I would have given you a pamphlet. You could have taken it home, but I can make sure you guys have access to all this information. But when you're buying a house and you are pre-approved, you start looking at houses, there's a list of things I don't want you to do. I mean, if this would be asterisk at the top. Tell me everything you decide to do before you do anything, before you make a decision, before you buy anything, talk to me. But these are like the do nots list, but I would say it's prefaced by, maybe you can, but talk to me first. You don't want to have too many inquiries on your credit report. You don't want to start shopping around for, a credit card, a car, a student loan all at the same time. That does bring down your credit score. So inquiries, you want to kind of curb those. When you're shopping for a mortgage, the good news is you have a certain amount of time, usually 14 days, to actually get as many mortgage inquiries as you want, and it doesn't affect your credit. Only that first mortgage inquiry. After that, it doesn't affect your credit anymore. But so the other stuff that could become concerning, or when you start doing inquiries after that time period, don't start racking up credit cards. Talk to me and say, you know what, my credit score is good. Christian qualified me for 300,000. Let's start, buying stuff. No, eventually you might not. The credit report's only good for a certain amount of time. We're going to eventually, most likely pull credit again, and that could tank your score. So, don't start racking up your debt. You don't want to go out and buy a Lamborghini or anything like that. If you do, let me know. I haven't been in one before. I'd love to take a spin with you, but that could ruin you getting a mortgage. That's for sure. Don't take it, and that goes with any kind of new debt. Listen, life happens. You might have to get to the point where, Christian, I need a car. I have to. My car, I got in an accident. I have to get another car. The payment's going to be a little bit higher. I got to get to work. Fine, we'll address it. We'll talk to me. We don't want this to come up later. So maybe we can say, okay, you know what? You can still do this thing. Maybe you qualify for 25 grand less. Or, okay, the payment's not changing. You're still good. Or, you know what? Let's get a cheaper car. We can have that conversation and make sure that we're all on the same page. Change your job. You don't want to change your job without talking to me, change your position. You never know what kind of, your income structure. Maybe you go to a commission only job. You think it's fine. Not necessarily. That actually could destroy a pre-approval, because with the commission income, with just, straight, with bonus, with overtime, we typically want to make sure you've been making it for at least 2 years in order to use that. So if you go from hourly, you go from, salary to commission only, could be in trouble. So that's important. Always, keep me in the loop with that. Anything you're going to change in your job, in your finances, in your debt, talk to me first. No, we talked about large deposits. Try not to, make large cash deposits in your account that we can't verify. Don't spend all your money. You might need that when you're buying a house. So, we want to make sure anything changing your financial picture, just talk to me first. Bottom line, me, Romano, Fabian, Ryan, we're commission only. So bottom line, we don't get you a house and we don't do good by you and make you happy and have you tell all your friends and your family how awesome we are. We can't eat food and we're not gonna have a job for very, very long. So we're here to help. We're here to make sure that you get into the house of your dreams, make sure you get into the financial picture that makes sense for you. And that's it. And if you guys have any questions for me, I don't know if we're doing questions now or if you want to wait till everyone else talks, but I'm done blabbing away.
Actually, Christian, I got one quick question. All those
Sure.
programs that you mentioned are amazing, first and foremost. But you did touch upon the CHFA or CHFA.
Yep.
And you did mention that there's some restrictions. Can you just kind of explain a bit more about the restrictions with CHFA?
Absolutely. So with CHFA, the big restriction they have is income limit. So depending on how many people you have in your family, like it's usually 1 to 2 people. And then if you go to 3 to 4, there's a larger income limit. I typically see it now around like 100 and it keeps changing like by the dollar. I think it's 105,000, 104,000. If you're there's 2 different versions of a CHFA actually. There's a FHA version and there's a conventional version. Conventional version is the best. You usually typically have to have better credit in order to qualify for it. But sometimes the income limits are actually a little more strict with that product. Sometimes they can only go to 80%, whatever the income limit is. But there's actually ways to get around that part too. One big thing with CHFA too is that they have an occupancy agreement that you don't really sign with anybody else. An occupancy agreement that says you have to live in the property for the life of the loan. And if they ever find out you move out while you have that mortgage, they will say, hey, pay me in full. You have 30 days. I mean, it's really crazy. They actually have investigators that I never thought, I thought like back a long time ago when I first started, I'm like, well, I mean, do they really check? I guess they do. They actually have a department that actually looks into that kind of stuff. So a lot of times, what I'll do with like multifamily houses, I'll have a conversation with you and I'll say, look, you know, half the reason why you buy a 2-family house or a 3-family house is maybe one day you want to move out and rent out the whole thing and really maximize your cash flow. CHFA, you might want to stay away from that because maybe we go into an FHA at that point. Because FHA, yeah, you have to put 3.5% down. That's actually how I bought my first house. But after, there's no limited time you have to stay in the property. So, you know, I think after 6-7 months, I decided to move out and rent out the whole thing. Didn't matter. You know, I intended to live there as my primary residence when I first bought the house, and I did. But eventually, you know, I got out of there. With the CHFA, there's some handcuffs with that. I could refinance you to a different product at that point, but then you're talking investment property, and then, you know, it's a higher rate, cost, stuff like that. CHFA, I would say another thing about them is they're a little more strict when it comes to how much you can qualify for. So a lot of times when I'm talking to my first time home buyers, I'll say, well, you qualify for this much for CHFA. If you happen to have the 3.5% down, you might qualify for this much. And usually there's a spread of like 50,000, something like that, depending. I would say those are the major restrictions with CHFA. Oh, one more thing with CHFA, I'm sorry. So like if you have any kind of charge-offs on your credit, any kind of collections, they're over, I think, geez, I gotta, maybe Ben, you know the amount, I'm not sure if I do. I could find that out, but over a certain amount, they have to be paid off in full. Whereas most products, you don't have to pay off your collections or your charge-offs. We can just take a certain percentage of that and make sure you still qualify. But CHFA wants you to pay off in most cases, like medical collections. Sometimes they're small, won't be required to be paid off. But like, you know, if you have a bunch of charge-offs and collections, those will have to be paid off before closing.
All right,
Christian.
perfect. I'm sorry, Ryan. Just one more.
Sure.
In regards to, because I know, you know, there's a cap, because before, I believe even last year, a year and a half ago, CHFA wasn't covering closing costs, and now they brought it back. And I know back probably 10 years ago, they were covering the down payment and closing.
Yeah,
can you explain the total that they cover?
Yeah, it's up to $20,000. So they will cover. It goes up to, I mean, it goes up to I think the loan to value is like 110%, but it goes up to, there's a max amount of $20,000. So you start to get into the larger houses. So that there's also a max sales price too for CHFA. For single families, it's 311,000 and change. So you start getting up to that amount. Sometimes you might not cover, you know, the absolute full amount with the down payment assistance, but usually it's almost the entire thing with that amount. Because you know, you figure the 3.5% down. Or the 3% down, depending on the conventional or FHA CHFA, and then the closing costs. So and now what they're doing with CHFA, they used to have you have to pay 1 point with that. So that's 1 point happens to be a higher percentage. It's 1% of whatever the actual loan amount is, or as a closing cost. Now they don't do that anymore. It's actually everything's a 0 point. So actually the CHFA closing costs are now getting less, a lot less than what they used to be. So it's a little easier to get everything covered in that down payment assistance amount. But yeah, $20,000 is the max total with the down payment and the closing costs.
And are you able to speak to the range that's required as far as credit score?
Yes, we can actually go all the way down to 580. That's good. That's a great question. I'm surprised I forgot to mention that. So that's for FHA, CHFA. We can actually go all the way down to 580. Obviously, it gets a little easier when you get above a 620. But I do loans down to 580 all the time. And you know, there's also ways we can actually go below that, but like it's like, you know, usually you have to put like a larger down payment down. You have to have, you know, some extra money in the bank. But you know, for the CHFA, it's 580. And I would say the conventional version of the CHFA, it's good to be probably, I would say, above a 680 to qualify for that. That all depends. We run it through their calculator, and sometimes you can go lower if there's some compensating factors, meaning there's some good things going on where you might have a big retirement plan or something like that. But I would say typically a 680, but 580 is the minimum.
So there is no maximum from what you're saying, is only a minimum.
Only a minimum. Yeah, you can go to whatever 830 and you can get the world with me. So, but yeah, 580 is a minimum. Yep.
Okay. If there's no other questions, thank you, Christian. That was really, really helpful. I learned a lot more than I already knew before. I'm a changed person now.
Well, I'm glad you guys had me. Thanks for having me on. It was great.
Perfect.
Thanks.
Is that a question?
Oh,
Sure.
yeah, we have a question.
Yeah.
Say you're not a first-time home buyer. Is it a time limit of years if you can requalify to be a first-time home buyer again? Like, say, for example, after 7 years, like how a bankruptcy would be, if after 7 years your credit, everything gets, you know, reloaded.
Right.
You understand what I'm trying to say?
Absolutely. Yeah. So there is a time limit. If you have not owned a property for 3 years, you can qualify for the CHFA again. So you can hypothetically do another, so you can do a CHFA loan, sell it, wait 3 years and do another CHFA loan. So it actually is, there's a way to, so 3 years is the limit. Actually, glad you brought up the bankruptcy. We can actually go depending on the product. So FHA, you can actually be 2 years out of bankruptcy and we can still do a mortgage. I know conventional is 4 years. And then, you know, there might be ways to get creative and go a little less than that on certain products, but FHA only 2 years.
Is it also 3 years for the FHA?
Yeah, well, actually FHA. So the rule with FHA is you can only have one FHA at one time, but you can do like, if you have an FHA mortgage, you sell the house, you can get an FHA again immediately. Or you could refinance your FHA to a conventional loan, keep that house, and then do another FHA loan. So as long as you don't have more than one FHA loan, you're fine. And there's actually a caveat where, you know, say you're relocating to a different state, you could actually have more than one FHA loan in that sense. I think if you're over like 100 miles and there's a couple other things that you have to qualify for, you can actually have more than one FHA mortgage. But in a typical scenario, you can only have one at a time, but you can get one immediately after the other one is gone.
Got you. Thank you, man. That's real helpful.
No problem.
And if anybody else has any other questions, that feel free to ask before we move on. Just give it a minute or give it a little couple seconds.
Sure.
But yeah, thank you for letting us know about CFHA, Christian.
Yeah, absolutely. It's a great product.
Yeah, it's quite a few new information pieces in there that I didn't even really know. And it's really nice to know about the minimum too.
Yes. Yeah, I think most places, I remember like, so another thing about CHFA that's cool with us is that we are, since we're the number one, I think we're one of only 2 CHFA lenders where we actually underwrite it in-house. The only time we have to send it to see it, like most people have to send to CHFA to get underwritten and get final approval. The only instance where we have to is when we're doing the down payment assistance. We have to send to CHFA for final approval. But since we have such a relationship with them and we do so many of them, it's like most of the time, you know, we're doing the mortgage, we're clearing it ourselves, and we're sending it over to CHFA, and usually they just stamp it and say, all right, you're clear to close. So it's like usually like a very, very seamless process. And yeah, and that's why we can go, a lot of places have a minimum credit score too with CHFA where they have an overlay. I remember, thought McHugh had like 660 was the minimum score. So since we're since a high level lender with CHFA, we can go all the way down to 580, which not many people can do. So
That's really good to know. It kind of gives people a leg up, I should say, when working with
absolutely,
you.
yeah.
Yeah.
Right. I always say, like, for me, like, if I kind of got a reputation in this industry of if it can be done, Christian could do it. So it's like, if there's something that can be done, I'm going to make sure every stone is unturned to figure it out. And of course, the best and cheapest way we can do it.
Well, I'm happy to hear that. And I'm glad everybody else here is probably definitely happy to hear that. And if there's no more questions, we're going to move on. It's going to be hard to follow that from Christian, but I'm just going to get into what we as agents do for pretty much any client. And as Christian said, that the market right now is kind of rocky. So when working with agents, it could be a short process. It could be a long process. I know I just finished with 2 clients myself, and one ranged from a short time period of 2 weeks, and one was 2 to 3 months. So when working with the agent, just be in mind that they have your best interest in mind as well, and they're going to work as quickly and as efficiently as possible for you. But the market is what it is, and we adapt and we try and get everything working. And in saying that, I just want to move on to the fact that when you're working with an agent, typically the steps include signing a representation. You choose your agent, preferably me, preferably me. Then you sign a representation agreement, and then they would move into financials. As Christian said, again, financials is one of the most important steps. You want to get everything down from credit all the way to all your personal information. As he said, you want to make sure that he receives all of your information. And if you're not sure about anything, we as agents are always here to guide you and to help you find that one pay stub that's just stuck under the couch and you just don't know where it's at. We're here for that. Just call us up. We'll help you figure out solutions to any step of this process. And as I heard before, honestly, at any point we'll join in. So if you're already dealing with, say, lending by yourself and you want to start getting an agent because you realize that, oh, this home buying process is quite a lot and I want some help, then you can contact an agent and we'll get you started with that pre-app. I mean, the sky is the limit, and we're as prepared, and if not more prepared than you are. So we definitely are ready and willing to get on that train with you. And really just to get off where I was saying, pre-approvals is the next step in the process after you got your agent and you settle what representation looks like for you. Pre-approvals are truthfully the step 1 in the whole process, because as I said earlier, the market right now is competitive, and it's super competitive. My 2 closings that I mentioned earlier, one was 2 weeks and one was 2 months, but they were looking since around August, honestly, and even earlier than that. They were looking for quite a while, and there was little to no houses, and it's kind of even trickier with multifamilies right now. The market's kind of dying down, and honestly, in that whole situation, you want to have your financials ready. So whenever there's that little jewel, that little spot on a corner lot in East Hartford that you're just like, yes, we're ready, and we got all your stuff lined up, and we could just toss in an offer right there. And just really mentioning offers and all of that, it's one of the most important things to us before we even get into the whole process, is getting to know you. And after pre-approvals and after lending is all settled and out of the way, we really like to get to know you as a buyer. And when we're out there house hunting, we like to note down your processes. Well, in the process of doing that, we like to note down your preferences. We like to know what you like in a house, whether you want your bathrooms upstairs on the left side or upstairs on the right side. You know what I mean? Everything that you could dream of. We'll let you know whether it's feasible in the market, but we'll try to find you that perfect fit all that you've been dreaming about. And in that process, again, no matter how long it takes, if you feel like, oh, I just can't seem to find a house, it's just nothing is working, we can't seem to win any of these bids, it's not abnormal for that to happen. The market is a literal fighting ring, and we are out there boxing for you. Don't worry. Well, we got your back, and no matter how long it'll take, we'll find you that house. And that's just something I'm gonna keep saying, because it'll always be tricky. House buying is a tricky thing, and that's why we work in this profession, to make it not tricky for you, to make it seamless. And just like Christian mentioned earlier, when it comes to lending and finding those programs that make the transaction like that, that's what makes the whole thing come together. And it's important to know that. And especially when dealing with a realtor, we try to make everything easy and seamless by providing you with recommendations, whether it comes to inspectors, to sometimes even insurance, everything. We try to have recommendations ready, especially when it comes to inspectors, just like I just said, because inspectors themselves, they do the more detailed digging that we can't cover. I might walk through a house with you and we might see that, oh, this house is really nice and done. But when you bring back an inspector, they'll be pulling up carpet, checking if you got some hardwood floors or if you got a hole right there. They'll be climbing on the roofs, sticking their head down the chimney to make sure that thing is working like it's supposed to. And that's important. That's important because you want to know what you're buying. Just like Christian said, to come and check with him, we have people that we have to make sure they check the house that you're buying, just to make sure. And that's definitely something that you want to make sure that you get a good inspector for. And we're there with a list of people that we recommend. I personally have already recommended to my 2 clients, and they went with my recommendation simply because they didn't have an inspector. But again, if you're familiar with the process and you are like, oh, okay, I shopped around, I found an inspector in my area, and I know they're thorough, that we will go by what you believe is assured, and will advise you indefinitely if there's any need for something that we know would save you time and money. So it's definitely an open process. When you're working with a realtor, it's not as if you're handing over everything to us, but even if you did, you could sit back and kind of relax and know that when there's something important for you to do, we'll send that your way, have you look it over, and you'll be involved at every step. And even if you wanted to take over and become a realtor for a day, we'll work with you to that degree as well. Just to really move on, again, I believe Christian mentioned that you would want a really good attorney. We make sure to provide a list of recommendations for attorneys as well. They're kind of the second half to lending, and your attorney is really important because they really hold your hand through the process in terms of the backgrounds. Kristen said they do really good title searches, and the attorney also backs that up by running through the history of the house and make sure there's no issues on the previous owner's mortgages or anything that might be outstanding on the deed of the house. So that's always important. If you have your own attorney, again, we would allow you to use your own attorney. It's not really, it's again, the home buying process is your process. We're just the representation that comes in and makes that easy. And as we keep moving forward, one of the things that we like to make sure that we keep on top of is inspections again, because that's kind of like heading towards the end of the transaction. Because whether or not your inspection comes back bad or good, we want to make sure we renegotiate with the sellers, and you have a period of time after an inspection report comes back for an unsatisfactory inspection. You list out anything that may cause a problem. We try to generally keep it to the major problems just to fit budgets. And even going off that, then we kind of get to the insurance section. This is definitely after inspections, your home, I like to say you're home free, but no, you're not really. We try to get ourselves ready for closing, and insurance is one of the big deals. We personally have some recommendations for that as well. If you have your own personal insurance that you want to stay with, it'll be fine. We'll work around that, but we try to minimize costs, as I mentioned before. And one of those things is insurance, and we try to get you the best premium, or try to work with any mortgage or insurance broker, I should say, to get you the best premiums that are possible. that'll fit your budget and allow you to pay your mortgage on time. So like Christian said, you're not eating ramen noodles with the heat off or something like that. You always got to have room for that stuff like that. And honestly, before I even started talking, I wanted to share a quote that I honestly just recently ran into. And maybe it was something I should have said earlier, but it goes, a seed is best planted 20 years earlier, and the second best time to plant a seed is today. And that's something I ran across as I was, getting into my whole real estate thing. I was like, oh, okay, that's something that anyone could find applicable, because if you'd bought a house 20 years ago, that would have been nice. But if you buy a house now, just like Christian said, it's some of the lowest rates right now. It would be almost lucky if you bought a house now, because compared to the interest rates faced in the past and potentially the future, it could be a ridiculous difference in the mortgage you pay. Honestly, and you could even see it in one of my clients. I honestly got super lucky with them, and in the fact that they decided to get a house now, they ended up cutting a deal where their interest was not even something a couple of years ago could compare it to, much less the beginning of the year. They are sitting well below what they would pay for rent. If I had to make up a hypothetical number that's not accurate, they're paying the $1,100 to a $1,500 rent. It's a vast difference, and it's something that you have to consider when being a first-time home buyer, is that you could just very well be saving yourself so much money by just buying a house, just getting into a rhythm of home owning. Know your trash days, don't worry, because if you have a fear of, oh, how am I going to handle having a house, we can also provide some recommendations for typical stuff such as contractors, plumbers, electricians. That's also part of our job as well, to help you throughout that process, even in the long term. And that's truthfully where I kind of wanted to end it, because the next step, if anything, one of the chief things that kind of gets in people's way is credit. And I have Ryan here, who's the credit master in this town. And I would like to hand it off to the sheriff. But first, if anyone else has any questions for me, I just feel free.
All right. Well, if no one has any questions, first of all, I'd like to apologize for my lateness. But my name is Ryan Balancier. I'm a realtor here at Fact Realty. I've been a realtor for probably about 6 months now, and I'm going to be guiding everyone through the credit repair process. As we've seen here, Christian gave you a whop load of information on credit in general and what needs to be there for you to be successful in purchasing a home. Obviously, there's minimum requirements, and no matter how minimum those requirements are, we always want it to be in our best interest so that we can get the best interest rate, best financing possibilities, whether it's FHA, CHFA, or anything like that. So today, what I like to do is just show everyone what the actual process is that they are using to judge you and your credit score, and how you can manipulate that system to work on rebuilding your credit. I'm going to do a little screen share here. All right. So this is the credit repair crash course. My presentation today is brought to you by CreditWise. This is actually an app included with the Capital One app. So if anyone here has a Capital One credit card, I'm not plugging them or anything, but if you happen to have it, this is actually right within their app. And as you're about to see, it is very useful in rebuilding your credit. All right. I'd like to say this an example today, but actually I'm getting pretty personal with you guys. I'm going to be giving you a little look into my credit score, and we'll be breaking it down to see what's good, what's bad, and how we can fix it. So first thing is first, everyone always says, what's good credit? So TransUnion and most other companies consider good credit to be a credit score of about 701 to 760, leaving a excellent or almost perfect to perfect credit score being 761 to 850. And everyone always says, oh, I have bad credit. Well, guess what? There's no such thing as bad credit. As you can see here, 300 to 620 is below average credit. So if your credit is not quite there and you're in that range, don't say you have bad credit, just say you're a little below average. It sounds better, right? So 735 looks like a great credit score, but as you see here, in about a month's time, there is about a 20-point drop. Now, why did this happen? And we're going to find out, and we're going to actually see how some of the stuff Christian was talking about can be impactful. So this is telling you why those 20 points were lost. If you look, your first thing is your oldest account isn't old enough compared to other people with similar credit profiles. What does this mean? We're going to get into that later. The second most impactful is you're currently using more of the credit available to you. So this goes back to what Christian was saying about the keeping it under 30% or at least keeping it under 50%. But one of the things I would tell you is that when it comes to credit and credit cards, any balance has an effect on your credit score. For every basically dollar you spend, it's almost like a point loss in your credit score. So you really have to be careful as you spend, because if you put $500 charge on your credit card, almost no matter what your available balance is, even if it's $25,000, your credit score will reflect that. So you must be mindful of that. Next, we have compared to the people with similar credit profiles, the total balance of all your credit accounts is too high. So this is actually saying kind of the same thing, that basically you're charging too much. You got to be careful. Your balances are exceeding what they should, and you really need to bring that down. Fourth most impactful, it says, and this one was actually a surprise to me because I never paid attention to it, and it was something that I really never considered as an effect on my credit score because I'd never seen it presented like this anywhere. But it says, it looks like you haven't paid much balance down on your open real estate accounts compared to what you originally borrowed. A real estate account can be a first mortgage, a home equity loan, or a home equity line of credit. Now, what that's speaking of is I've been a homeowner for about 12 years now, almost 13. And most times I've only used minimum payments to pay off that loan, whereas most people would encourage you to put some money on top of the principal. Not only would that help in a situation like this with adjusting your credit score, but it would also help you shorten the amount of time you actually pay on your house and assist with interest, because the interest is basically based on the amount borrowed and the overall amount. Well, if you're putting extra money towards that and knocking it down, that's that much less interest that can be charged to that loan. Okay. This here is just kind of an overview of, in general, everything that affects your credit. So your on-time payments, all right, your oldest credit line, your credit used, the recent inquiries on your credit, your new accounts, and the available credit. Now, some of these things you guys may know already, but I think some of the things I'm about to get into in detail with these things might actually surprise you. So obviously we know that if you make 100% of your payments, that's in your best interest. Anything below that, this is now showing you if you're 98 to 99% is considered good. So that's going to have that type of reflect on your credit. 90 to 97 is average, and anything less than 90% is below average. And that will obviously bring your credit score down, however amount of points, based off of this issue. Next is the age of your oldest account, okay? Now, if you look here, excellent credit is considered an account over 25 years old. I don't know about you guys, but I'm bordering 40, okay? But I'm not quite there yet. So 25 years of age of credit is not really feasible for me because I've maybe only been establishing credit since 20 years old. So I'm only maybe close to, 20 years in. So there's certain things with your credit that there's only so much you can do about it now. It's kind of what Romano said earlier about, the best time to plant a tree. Like, you can't go back and add years to your score. There might be some tricks where you can, but that's for a more advanced credit repair course. But what I'm basically saying here is however long you started your first account is the age of your oldest credit. There's no way to get around that, obviously. And to have perfect credit, they're looking for 25 years plus. The one thing I would encourage everyone to be careful of is if you're being really responsible and you're keeping your cards at like a 0 or very low balance, you'd be surprised to find that sometimes if it stays at 0, they will actually close your card. And I had this happen recently with a jewelry store card because I'm not a rapper or anything. So I don't spend most of my time buying jewelry. So I had a jewelry store card that had a 0 balance and I hadn't used it in probably a year or two. They ended up closing it, which that's not a big deal, right? Well, actually for me, it was because that jewelry store card was actually my longest credit line. If I still had that card active right now, instead of 14 years here, you'd probably see about 16. I actually tried to reopen the card thinking it would add back the time, as I've seen done with Capital One and certain other credit cards. Even if you close the account, if you had an account with them and you reopen an account years later, like Capital One, it will actually reflect the entire time. That's why I'm blessed right now to have 14 years. I'm pretty sure that's a Capital One account. And I just closed it probably about 5 years ago and opened it about a year or two later, but yet it still reflects the 14 years. So that's really important because this is not something you go back on. So it's probably good to know what your oldest account is and maintain it to your best ability to keep it open, to keep it in good standings and stuff like that, because it does reflect on your credit. Another thing, which also goes back to what Christian spoke on earlier, is your inquiries in the past 2 years, okay? People always say they're going to purchase a car or a credit card or a store card or anything like that. And we always say like, oh, I'm afraid to run this application because it's going to, deduct a point from my credit score. Well, I'm here to tell you it's not so much a point system, but the amount of inquiries just straight up decides where you fall. As you can see here, excellent credit, you have 0 inquiries. Good credit, you're at 1 to 2, average 3 to 5 inquiries. So these accounts could be accounts that you applied for and were not able to get, but they could also be accounts that you opened and did get the account. It doesn't matter. It's still gonna be counted as an inquiry on your account, and that in its own way has a negative reflection. So unless you're building credit and you need to get new credit cards, or you're in the situation of purchasing a new home where obviously you need a lender to run your credit, you should always, when trying to keep your credit straight, keep the inquiries as low as possible. So at the same time as the inquiries, the new accounts themselves have a negative effect in the way of how many you opened in the past couple of years. So it's only 2 years for both of these, the inquiries and the new accounts. So obviously it kind of falls off after that. And if you would open an account 3 years ago, and that was the only inquiry you had, that account wouldn't show up right now. So, you'd be at 0 inquiries and hopefully excellent credit, but obviously there's many other factors to that. So any accounts you open new, they may bring your credit score down, but there's other factors, which one of them I'm going to talk about very soon, which by opening this account can actually have a positive reflection on your credit, which will allow you, to feel good about what you've done and not be concerned about this new account or this inquiry on your credit. Now, that thing that I was talking about is your total available credit. So there's this myth that a lot of people believe that the amount of credit you have available, meaning you have a credit card and the card has a $10,000 available balance. There's people out there who believe that's a bad thing. Some people think you can have too much credit. And it is true, but you would have to be like at an 850 score, have multiple credit cards that probably each had about a $50,000 more balance on them to really reflect negatively of having too much credit. But what we're talking about here is if you want to be in the level of excellent credit, they actually want you to have over $50,000 in available credit. So whether that's multiple credit cards, one card, whatever, but it should be 50,000, which a lot of us, if you're in the 600s or 700s, that may be a task. But you work and you build and, you grow and eventually you'll get there. A lot of times, if you've been in very good standing with your credit cards, you can request a credit limit increase. You'd be surprised how much money will be added. You could have been like $3,000. You're in good standings. You have like a 700 credit score. The account has been going on for a few years. And now you apply for a credit limit increase and 3,000 turns into like 10,000. It's possible. I've seen it. I've done it. So, you just be diligent and work on it and you can make it happen. The other thing is there's certain banks that you apply for one card, you might only get like a $5,000 limit, but other banks, I've noticed TD, if you have a good credit score, they will actually give you a pretty large amount in credit cards. So reaching that $50,000, if you know the right systems to invest into for your credit cards, it could definitely help you and be an easy process. So, I mean, that's basically my spiel about the credit repair. I didn't talk a lot about repair, but the main things you need to know is pay off your debts and do not settle. When you settle with creditors, it actually has a negative reflection in the way of your credit score. It goes up, but it doesn't go up. Okay, it's the same if I said you owed me $100. I waited a year harassing you to pay it. And then after a year, I kind of got tired of asking. So I said, you know what, give me $60 and we'll call it a day. That's basically what you're doing if you're settling with a creditor. Now, if you did that to me and you owed me another $40 and never paid it, do you think when you turn around again and ask for $100 that I would, give that to you? No. And that's basically how it works with credit. It has that kind of same negative reflection of like, yeah, you paid, but I had to pull your teeth for it. And I didn't even get it all. So your credit score is not going to reflect, say it was supposed to go up, 30 points with full payment, or it would never be that high, but let's say 5 points and it only went up 2 or 3, and that adds up for each thing you have in collections, which you have to be careful of, because there are some people out there who will, as credit repair agents, get all of your debt settled in one, paid down in one loan, and you're paying them. But if they settled everything for you and they didn't pay it all in full, then your credit's not going to reflect positively as it could. And if it's already low and now you're shorting yourself in the bring up of that repair, then you're not going to see the score you like to see. I can honestly tell you about 2 years ago, the reason you see that 735 now is 2 years ago, I went very crazy on my credit repair and started paying off every piece of debt I had, along with accruing these accounts and things like that. It was able to show me a much better score. But I've seen the 500s, I've seen the low sixes, I've been there, we've all been there. It's a repair process. Sometimes it's long, sometimes it's short. Probably student loans, some of the worst things to deal with as far as credit repair. They can have a major negative effect, and sometimes you don't even get out of it what you wanted. So that's basically it. Any questions that you guys have, feel free to ask. What's the mic? No, what's your question?
If I have my son as authorized user as 13, would that his credit start from there? So then 25 years later, he's had that established.
Okay, so one of the gentlemen here asked if he adds his son as an authorized user on his credit card, will that enable him to have his son in 25 years at the age of 38, reflect that he's had 25 years of credit? You're cheating right now because that was some of that advanced stuff we were talking about. But the answer is yes. That's what a lot of wealthy people do. A lot of people that have good credit and know how to have it. If you put your child as an authorized user on your card, your credit will reflect on that account. This is not for you to do in the fact of opening up cards under your children's name or doing any of that stuff that people do with the bills. But this is saying on your credit card, you put your child as an authorized user. And now at 13, if you've had that card for 5-10 years, your 13-year-old child has a credit reflection of half of their life or their whole life, depending on how long you've had this card. And that will actually start them building credit before they're actually even old enough to really have it. Like I said, those are the things the wealthy do to get their children starting off. That's why, you see some rich people, their child is 18 in college and they already have an 850 credit score because their parents have already put them as an authorized user on their cards. Their cards, hey, got 20, 30 years of age to it. And now it's reflecting on this 18-year-old. Guess what that means? Perfect credit. And as long as they don't have any debt or anything, well, mom and dad, you just did most of the work for me. So very good question. Any other questions?
All right, so Ryan, overall, so what we're getting at is, sometimes you have clients that will come to you and, people believe that it's impossible because they have a few little blemishes on their credit and whatnot. So basically the gist of this is saying that, with certain or just a few adjustments, and even what Christian said earlier, the fact that they could go down a bit lower on the credit spectrum, that person's dream or goal of home ownership is a lot more attainable than a lot of people think. You know what I mean? You can move a few pieces and put them right in position to do so, right? So I that breakdown makes a lot of sense, because a lot of times people feel as if, man, if their credit got hit at some point because life happens, knowing that it is an uphill battle, sometimes people feel hopeless. But with the strategy that you're using, it seemed like it's definitely feasible, and it could be feasible in a shorter turnaround.
Very right. That's one thing I would really like everyone here to understand. That is something that I have preached personally since before I was a realtor. Like I said, I've been a homeowner for probably about 13 years now. And I thought it was an incredible feat. I had a very close friend who, over getting a dog that his parents wouldn't let him keep at like 22 years old, he was established, he was doing well for himself, had good credit. He went out and purchased his own home. off the strength of he wanted a dog and his parents, you know, didn't want one at the house, but he was in a financial situation where he could do it. But for me, as his friend and as like 22 or 23 years old at the time, to see him do something like that, that I thought was such an impossible feat and such a big deal, you know, it was impressive. But shortly after, 2 or 3 years, I did the same thing with the help of my mom. You know, we were able to purchase our own home. And, you know, sometimes that's what you have to do. You work with, you know, whoever. But the moral of the story is the process is not as hard as people think. And it's much better that you make that effort to try to secure yourself and your family. You know, one of the big reasons that pushed me to buy a home was, one, my mom and I have been evicted multiple times from where we were living. And I was kicked out of where I was living with no choice. At 18 years old, I was living in a basement with my mom and like 3 cats. And that wasn't cool. And that was just the first eviction, I want to say. By the second one, I was sick and tired of it. And I said, I just want that control, that home ownership, to have my own place, my own peace of mind. You know, and when you're talking about multifamilies, it becomes an investment, something that can generate finance for you and generate generational wealth for your family as you pass it over to your kids and things like that. So home ownership in comparison to renting, to me, there's no, you know, doubt about it. People worry about maintaining their home, things like that. Guess what? You're working with a realtor, and when you work with Prefect, we look at everyone as family. We're going to take good care of you. If you have a home that needs work, guess what? Fabian does flips all the time. We can recommend multiple different contractors, you know, so it can be much deeper than just the purchase process. There's a lot more to it. So I just want everyone to know that home ownership is not hard. Okay, it's like buying a car on a larger financial scale, but the process is almost similar. Cars go through the same underwriting process of people as mortgages do. And it's really the same thing, like I said, on a bigger amount. So I hope that everyone hears what we're saying today, and it gives them more courage to go out there. And the last thing I want to say is that a lot of people say a single family home is an asset. And in a way that is true. If it happens that you purchase a single family home and over the course of ownership, that house goes up in value, along with you paying on that property, you know, getting that loan down, you're establishing equity, hopefully, because it's, you know, it's not losing value. Hopefully it's maintaining its value or going up. But you can't really call a single family home an asset until you sell it. Until then, it is a cost, 100%. Whereas a multi-family home can generate income for you. So it is an asset at all times until it kind of starts breaking down on you. And then hopefully you're in good standings to get rid of it. All right. So thank everybody. If there's any more questions, we will be here. So ask away.
Appreciate that seminar. Good job, Rye.
Appreciate it.
And just so you guys know, anybody that doesn't see anything popping up on their screen, Kristen was able to leave his contact there also. And just in case you don't even have that, you contact Ryan or Romano, and they'll point you in the right direction and get the ball rolling.
Yeah, so check the chat, everyone. If you're interested in the chat boxes, Christian has his information there. He's really good. I've had him work with a couple of my clients already. Seems very thorough, and he gets back to you immediately. So that's great, you know, and thank you, Christian, for coming. Thank you for what you've already done and for everything you're going to do.
Thanks, guys. I appreciate it.
Thank you.
All right, and if no one has any questions, we're gonna wrap it up. Romano, we can leave the room open for a minute just in case anyone needs to get Christian's information. If anyone needs our information, let me know, but I'm pretty sure everyone here already has it. But thanks again for coming. We appreciate you all joining us. And we will be doing this again. So if you need it or anyone you know needs it, stay tuned. Thank you.
Yeah, I'll be leaving the room open, just like Ryan just mentioned, and I'll also be sitting in the room. So if you guys have any outstanding questions that you didn't get to ask and you want a little privacy, I'll be right here.